2026, we expect the 10-year German bond yield to be less volatile as we see downward and upward pressures that will offset each other throughout the year. On the positive side, the statu quo of the European Central Bank, anticipated for 2026, will provide stability for the short end of the curve, which should benefit to the 10-year segment due to the existing slope and carry. Factors that could put pressure on rates are the increase in gross issuance and the Dutch pension fund reform that is likely to wait on the very long end of the curve beyond 10-year maturities. We expect the 10-year German yield to stabilize around 2.8% by year-end, and we expect an additional 20 basis points of steepening in the 10 to 30-year part of the yield curve. As for spreads relative to Germany, we believe periphery bond markets like Spain, Italy, and Portugal are still in a good shape. However, after the significant move last year, further tightening may be more challenging, limited potential for outperformance in 2026. Regarding the French spread, we expect it to settle at a higher equilibrium level due to the less favorable fiscal trajectory and political risk ahead of the presidential elections in 2027. We anticipate a level of around 80 basis points by the end of 2026. In the United States, there is an increased economic and geopolitical uncertainty. However, the expected moderation of inflation, the deterioration of the labor market, and the repositioning of the Fed's governing council favor an accommodative monetary policy, with the Fed fund rate expected to fall to 3% this year. As for bonds and the yield curve, we expect some volatility due to the high deficit and upcoming midterm elections. Artificial intelligence valuation risks and private debt vulnerability are also factors that can influence the bond market. We expect the US 10-year bond yield to trade at around 4.3% at year-end. Regarding emerging markets, the growth differential versus developed markets is clearly favorable, with a steady improvement in their credit ratings. The asset class offers serious advantages for 2026, with a carry of around 7% on external debt and a renewed positive dynamic in inflows.